Now with this, we move to second section of this topic is to talk to you about what are the different types of borrowing, right? So here we focused on, what was a qualifying asset, what is actually a borrowing cost in itself, and then we talked about how do you look at the capitalization and so on and so forth for the scope exclusions. Now we're going to specifically focus on that there are different types of borrowing, right? So what are those types of borrowing? The two types of borrowing essentially from the purpose of this standard, one is called specific borrowing and the other one is called general borrowing, right? Now what is the meaning of a specific borrowing? Okay, so a very simple example is, let's say, there's a building, right? Now you decided to construct a building, right? Now to construct a building, you decided to borrow money. So if you borrowed money from bank, which is very specific, identified, attributable to this construction of this building, right? Then this type of loan is called specific borrowing, right? Now there could be another scenario in which it is said that you are still doing the construction of a building, right? But you decided not to borrow any money specifically which is attributable to this construction of the building, but you have several other loans which are running in your balance sheet, and which now the money, the loan which you have, which you are using now for the purpose of construction of a building. Okay, that is then form part of your general borrowing, right? Now many a times, this is very, very interesting. Okay, so many a times, we hear, when people will say, look, the money which I had borrowed in the previous period, that was for working capital purpose, right? Or that was for, specific purpose, that was for some other purpose, right? Or for corporate purpose. Now, why am I need to capitalize this, right? With reference to the building, if it is not specifically borrowed for that building, right? And that's where the whole concept comes in, is to say that money is fungible. Money is fungible. Now that's a very, very important thing which you need to remember, which is what we call as money is fungible. What does this mean, right? Money is fungible means what? Means that money which is in your left pocket or right pocket, it doesn't matter. It's the same currency. It's the same cash which is sitting with you, right? Now, the standard simply suggests that if you are building a qualifying asset and if you have an interest cost, then the interest cost which is attributable to that qualifying asset is eligible for capitalization. In other words, if you were not incurring cost in relation to this construction, you could have actually saved interest by repaying this loan, right? Because so you decided not to borrow more money, right? Now, if you decided not to borrow more money, that means, and you're doing this construction of a fixed asset, right? New asset. What does this mean? That you actually have funds, which you can actually deploy to start building a new asset, and you decided not to borrow a new money, right? But end of the day, it is still money, right? On which you are actually incurring interest, which you could have potentially saved if you were not doing this capitalization process. And that's where the whole concept comes in, that money is fungible, right? It doesn't matter that if I borrowed money, let's say the challenge which we actually commonly see, let's say there was a plant, there's a plant A, right? I borrowed money when actually I was doing the construction of plant A. Now that plant A is now fully operational. Okay. Now the principle which I explained to you, that was a qualifying asset, the construction is complete, you capitalized money, right? I borrowed money against specific to this plant A. Now that is called specific borrowing, right? However, let's say I started, once the plant A complete, I started actually doing construction of plant B, right? Now this time I decided not to borrow any more money. But I still have, assuming this loan outstanding in my balance sheet. Now this plant A construction is already complete. Now what happens for the purpose of plant B? Then this money which I had borrowed for plant A becomes part of general borrowing. Now that's an important concept. This is where again this is in practice we see this as very different than what existing Indian GAAP was all about, right? Which is where to say that money is fungible. The concept of money is that it is fungible. Okay, so if you borrowed money, if you have borrowings on left hand side of your balance sheet, and if you are doing construction of an asset on the right hand side of the balance sheet, and this asset is a qualifying asset, then the interest cost which you are incurring is eligible for capitalization. The question we are asking or trying to address in this section of the discussion is that at what rate it is eligible for capitalization, right? Now the rate is dependent upon whether it is a specific borrowing or it is a general borrowing. If it is a specific borrowing, then that rate is what gets applied to for that qualifying asset. If you don't have a specific borrowing or the specific borrowing is already been exhausted, then the weighted average rate of a general borrowing gets applied to appropriately determine the rate of capitalization. And that is what we will try and help you understand and explain with the help of several examples in this section. Okay, but important thing for you to remember that money is fungible. Just because I have borrowed money which was attributed to a specific asset, now once that asset has been completed, that money, if continues to be outstanding, it actually becomes part of my general borrowing pool. Right? It is then no longer specific to that asset, because that from an accounting perspective, okay, from a lender perspective, it is, let's say, it's still hypothecated to that plant A, right? The lender is not going to hypothecate that to plant B because now I've started constructing plant B. From a lender perspective, it may continue, but from an accounting perspective, that loan actually now becomes part of the general borrowing pool, from that perspective, right? So borrowing costs that are directly attributable to the acquisition, construction, or production of a qualifying asset are included. So that is what is called specific borrowing. So I am building a plant A, right? And I borrowed money from the bank against the construction of this plant A. That is what is called specific borrowing. Okay, that is what is being called specific borrowing. Now, so what is the other element of the specific borrowing, right? The amount capitalized should be the actual borrowing cost, net of any income earned on the temporary investment of those borrowings. All right. The amount capitalized should be the actual borrowing cost, net of any income earned on the temporary investment of those borrowings. All right. So if you have deployed the surplus fund during this period, whatever you earned out of that deployment, that is to be adjusted in the case of specific borrowing. This issue is not relevant from general borrowing, because the general borrowing you only capitalize with reference to the amount which is spent, and we will try and help you understand this with the help of few examples. Let's look at this case study. On April 1, 2019, a company engages in the development of a property which is expected to take 5 years to complete at a cost of INR 60 lakhs. 5 years to complete at the cost of INR 60 lakhs. For this purpose, a bank loan of INR 60 lakh. So I did a specific borrowing of a bank loan of 60 lakh with an effective interest rate of 6% was taken on March 31st, 2019. And fully drawn on the same date, I've taken the full money. Interest income earned at the rate of 3% on the unapplied fund during the period was 1,14,000. How much interest I earned during this period when this was lying idle was 1,14,000. How much interest I was paying? I was paying interest at the rate of 6%. How much I borrowed? I borrowed 60 lakhs, right? So the question here is that what is the amount of interest to be capitalized for the year ended December 31st, 2019? Remember, we're talking about December 31st, 2019. I borrowed money on 31st of March 2019. That means we're talking about a 9-month period, not a 12-month period, right? So these dates are very, very important for you to get it right, right? Now, 60 lakhs, right? 60 lakhs at the rate of 6%, right? For a 9-month period, right? How much is my total interest cost? Okay, how much is my total interest cost? Is 2,70,000, right? How much interest which I have saved, that information is given, is 1,14,000. How much interest you are allowed to capitalize is 1,56,000. All right, 1,56,000 is what you are allowed to capitalize. Let's look at another case study, right? Alpha Limited on April 1, 2019 borrowed 9%. At the rate of how much money they have borrowed? 30 lakhs to finance the construction of two qualifying assets. There are two qualifying assets here, right? How much I borrowed? 30 lakhs at the rate of 9%. Construction started on April 1, 2019. The loan facility was availed on April 1, 2019 and was utilized as follows, with remaining funds invested temporarily at 7%. How much I was able to make on the idle money? 7%. And I've deployed on April 1, 5 lakh and 10 lakh and 5 lakh and 10 lakh on October 1. Calculate the cost of the asset and the borrowing cost to be capitalized. How much I deployed on factory building? Eventually 10 lakhs. How much I deployed in office building? 20 lakhs. But the period is different, right? Here 5 lakh was deployed on April 1, here 10 lakh, here 5 lakh on October 1 and 10 lakh on October 1. What is the rate at which I borrowed money? I borrowed money at the rate of 9%. How much I was making during the idle money? On the idle money, how much I was saving? I was saving at the rate of 7%. Right? Now calculate the cost of the asset and borrowing cost to be capitalized, for year ended 31st March 2020, right? In the 1 year period, right? So here you have to write an assumption that I'm going to do it for 2020, right? So borrowing cost 10 lakh into 9% is 90,000, and then there's an investment income. So for the full year, the interest cost was 90,000 on 10 lakh on factory building 1. Now I redeployed this money at 7% for a 6-month period, and I saved 17,500. So my actual interest outgo on account of this building 1 is 72,500. I apply the same computation process. My actual interest cost outflow is 1,45,000 on 20 lakh, which I deployed. 20 lakh at the rate of 9%, 1,80,000. 20 lakh I actually 10 lakh, which I was able to redeploy at the rate of 7% for the period 6 months. I made 35,000 on that, right? So my total cost, my cost of acquisition, my cost of construction is 10 lakh and 20 lakh, and the interest cost, which I'm going to capitalize. So my total cost, which is getting capitalized under Ind AS 16, including the concept of Ind AS 23, as we just talked about, is 10,72,500 plus 21,45,000 is what I am need to capitalize, because this is a case of a specific borrowing. Specific borrowing. Now we're going to talk about general borrowing. General borrowing. That means anything which is not specific, everything else is general borrowing. Everything else is general borrowing. If it is not specific, it becomes general borrowing. If it is a specific borrowing for a particular plant, once that plant construction is over, it is ready for its intended use, that specific borrowing which was for a plant A, actually if you are doing a new capex, then that specific borrowing also becomes general borrowing for plant B. And that's where the whole concept of money is fungible. Money is fungible. You could have then saved that interest by repayment if you had not started a new construction of the plant B. And that is where the concept of general borrowing comes in. Anything which is not specific becomes in a way a general borrowing. In the case of a general borrowing cost related to the funds utilized for acquisition, construction, or production of a qualifying asset to be capitalized shall be calculated by applying a capitalization rate, to the expenditure on the related asset. Now, this is an important concept for you to understand, that how to compute the capitalization rate. It's simple, but still a concept which you need to remember. How to compute the capitalization rate in the case of general borrowing. In the case of specific borrowing, capitalization rate is nothing but the amount of interest rate is what you are going to pay on that specific borrowing. In the case of general borrowing, because you may have multiple borrowings going on at multiple different rates in your financial statement, that is why you need to then compute a weighted average rate to determine the rate which is eligible for capitalization, because money is fungible. You don't know whether I'm funding this from my working capital loan or from my corporate purpose loan or for some other loan which I've taken, so on and so forth. So you got to do this with reference to the capitalization. You got to determine the rate of the capitalization. The capitalization rate should be the weighted average of the borrowing cost applicable to the borrowing of the entity that are outstanding during the period other than specific borrowing. So you got to look at every other borrowing, every other interest cost which is out there, and then determine your capitalization rate. So how do you want to calculate this? We're going to try and help you understand this with help of few examples as well, right? The capitalization rate shall be the weighted average of the borrowing cost applicable to all borrowings of the entity that are outstanding during the period. However, an entity shall exclude from this calculation borrowing cost applicable to borrowings made specifically for the purpose of obtaining a qualifying asset until substantially all the activities necessary to prepare that asset for its intended use or sale are complete. So if you're already having a qualifying asset which is under construction, for which you have borrowed money, you don't need to, because that is anyway getting capitalized as part of that qualifying asset, right? However, if you have borrowed, then you have general borrowing, you're doing another qualifying asset, that is where you got to appropriately determine the capitalization rate. So total general borrowing cost for the period exclude the specific borrowing is weighted average. How do you determine this capitalization rate? Is weighted average total general borrowing equals to your capitalization. That's the formula. What's the formula is total interest cost is what you have in this period, excluding the interest which you're going to pay for your specific borrowing, right? And then you're going to divide this with total outstanding weighted average of total general borrowing, because, so it's a weighted average total general borrowing excluding the specific borrowing. That will give you your capitalization rate. And let's just try and do this with help of few examples. All right. So here in this example, you have an entity which has three sources of borrowing in the period. Three sources of borrowing in the period. All the borrowings are used to finance the production of qualifying asset, right? So my outstanding liability is 60 lakhs. Here it is 1 crore. Here it is 40 lakhs, right? And my interest cost is 8 lakhs, 6 lakhs, and 5 lakhs. See, the different amount, different rate of interest is applicable, right? Different rate of interest. And that is why it is important for you to determine the capitalization rate, right? Calculate the appropriate capitalization rate. So how are you going to compute this? You're going to first look at the total interest, you're going to look at my total liability, and then you will be able to determine your appropriate capitalization rate, which is my total interest, it is my liability, and then that is become your 9.5%. Okay, now if there is a possibility that some liability gets repaid during the period, right? If the liability gets repaid during the period, and that's where, if I go back to the formula, right, we were saying that you got to look at weighted average. This only becomes relevant if you have repaid. If you have not repaid, then you are okay, right? Then it is very simple the way you see here, right? Which is outstanding liability, and look at the interest. Now, if you would have repaid a portion, then it becomes slightly more complex, right, in terms of its application. Now, expenditure to which capitalization rates. Now, you have determined the capitalization rate. Now, we need to determine the expenditure. So, let's look at some of these principles. In calculation of borrowing cost to be capitalized, the amount of expenditure on a qualifying asset. So, and to determine the borrowing cost to be capitalized, right, the amount of expenditure on a qualifying asset include only those expenditures that have resulted in payment of cash, transfer of other assets, or the assumption of interest-bearing liabilities. Expenditures are reduced by any progress payment received and grants received in connection with the asset. Let's say this is largely relevant in the case if I'm trying to capitalize this for inventory, where the customer may continue to make us payment as well. Then I know one side, if I'm receiving payment from the customer, then I can't continue to capitalize on the gross amount. I got to keep on reducing the sale of consideration, which I've already realized. The average carrying amount of the asset during a period, including borrowing cost previously capitalized, is normally a reasonable approximation of the expenditure to which the capitalization rate is applied in that period. We will try and understand this again with the help of a case study. All right, let's just try and look at this. There's a Beta Limited had the following loan in place at the end of March 31st, 2020. 18% bank loan, 10 lakh, and then on 16% term loan, 30 lakhs. On March 31st, 2020, the 10 lakh, 30 lakh, and there's a 14% debenture which also pops in at 20 lakhs. Now, the 14% debenture was issued to fund the construction of office building on July 1, 2019. But the development activities are yet to be started. So this is again, I've issued is a specific borrowing, right? It's a specific borrowing for office building on July 1, but it is yet to start. On April 1, 2019, right, Beta Limited began the construction of a plant being a qualifying asset using the existing borrowings. These are my two existing borrowings. Expenditure drawn down for the construction was 5 lakh on April 1, 2019, 5 lakh on April 1, 2019, and 25 lakh on January 1, 2020. How much I have? I had actually in total 40 lakhs. How much I've spent? I've spent 30 lakhs, right? I've spent 30 lakhs. I had 40 lakhs, but I spent only 30 lakhs, right? So what is the question here, right? The question is to calculate the borrowing cost on general borrowings to be capitalized for the plant. Calculate the borrowing cost on general borrowings to be capitalized for the plant, right? So I need to calculate the borrowing cost, right? How much is my borrowing here? 10 lakh and 30 lakh. What is the rate of interest at which I borrowed money? 18% and 16%. Then is this a specific borrowing or a general borrowing? This is a general borrowing, right? What was the specific borrowing here? Specific borrowing which I did for the purpose of this office building, right? Which I have yet not started deployment. So what is it we need to do? We need to calculate the borrowing cost on general borrowing. There are two general borrowings and I have deployed money 5 lakh and 25 lakh. So how do I go about this computation? Calculation of capitalization rate. 18% into 10 lakh, 16% into 30 lakh divided by 10 lakh plus 30 lakh. They were outstanding during the entire year. That gives me my rate of capitalization as 16.5%. 16.5%. Okay. This was outstanding for the entire year. This is what my total interest cost. My blended average interest cost is actually 16.5%. And then I'm going to look at, there are different dates of expenditure, right? The first is I spent 5 lakh into 16.5%, for the entire year, right? That I spent at the beginning of the year. So I'm going to capitalize for the entire year. The 25 lakh, which I'd actually deployed on January 1, I'm going to capitalize interest only for 3-month period, apply the same 16.5%. That number comes to 1,85,625. That is the total borrowing cost which is allowed to be capitalized following the principle of Ind AS 23 in relation to general borrowing. I have not considered here specific borrowing, all right, because specific borrowing was in relation to office building. And that construction is still to happen. If this office building would have been completed, then this specific borrowing also possibly would have formed part of my general borrowing pool. And then I would have considered it for me to determine the appropriate capitalization rate. All right. Let's try and quickly recap of whatever we've talked about. Borrowings are of two types: general borrowing and specific borrowing. Something which is specifically borrowed for construction of a fixed asset, that is specific. Everything else is actually a general borrowing. The purpose of this specific borrowing and general borrowing distinction is to determine the appropriate capitalization rate, is what you are supposed to use to capitalize, right? And then we talked about how do you compute. If it is a specific borrowing, the rate of interest, that is what is considered. If you have generated surplus fund during the period of deployment, that is to be reduced from the interest cost which you have incurred. If it is a general borrowing, then there is a formula which is what you need to use to compute the capitalization rate, and then use that capitalization rate against the deployment dates, and then determine the deployment dates to the date of your reporting, provided the construction is still continuing on the date of reporting, for you to determine the appropriate amount of borrowing cost which is to be capitalized. All right. I hope this gives you a good perspective on what is the distinction between general borrowing and specific borrowing, and why this distinction is important for you to understand, to determine that how much of my eligible interest cost, or how much of my interest cost, is actually eligible for capitalization. And we've tried to help you understand this with several examples which you need to again understand, and then your concepts have to be clear for you to appropriately absorb the whole topic on Ind AS 23 in terms of, what is the part of my borrowing cost, what is a qualifying asset. When I have a borrowing which is in foreign currency, how do the rules around the exchange laws do operate? What is the distinction between a general borrowing and a specific borrowing? The whole concept that money is fungible, whether the money is in your left pocket or right pocket, it still is, it's currency, it's still money. And if you are using if you're doing a construction of a fixed asset, or construction of a qualifying asset on the right hand side of a balance sheet, and you have a liability on which you are incurring interest on the left hand side of the balance sheet, that interest is actually eligible for capitalization. You need to then determine how much of that interest is eligible for capitalization, and that is dependent upon whether it is a specific borrowing or whether it's a general borrowing. If it is a specific borrowing, then you capitalize at the rate at which you borrowed the money with reference to that qualifying asset. If it is not a specific borrowing, then you need to determine the rate of capitalization by determining the capitalization rate, and then apply this rate to the expenditure which you have incurred in relation to that qualifying asset, and then you will determine the how much of the interest out of that is eligible for capitalization. Everything else is nothing but period cost or an interest cost which is required to be charged to profit and loss account.